Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Are we going? I didn't get the thing to start the broadcast. I think I got this going correctly. Hold on a second. I'm gonna refresh this page over here. Okay, I think we're okay. Say hello if you can hear me. Anyways, welcome back over to the charts real quick because we do have some news in 3 minutes. But you can see here most of the charts just kind of going sideways here. Gold and silver, copper having a little bit of a bad day. Bitcoin and the dollar coming back up. So there's a little bit of how do I put it? Anxiety. There's a little bit of anxiety here ahead of this PCE number. So US core PCE price index month over month. We're looking for a reading of spot 4 versus a previous reading of spot 6. Also, we get US consumer spending and personal income. US consumer spending, we're looking for a reading of spot 3, and personal income, a reading of spot 2. So, we wait. And we're at 3.555. Nobody said anything, so I'm just going to assume that I'm not broadcasting. Okay, not as much pulling. Okay, there it is. I was going to say, it's not pulling as much as I thought it would. We're probably not going to be able to trade this live here. Just remember that it was at 3.555. 14.65 here. Hey, not bad. It sounds like it's better than expected. Okay, so I am getting U.S. personal income slightly higher than expected. Spot 3 versus spot 2. We're good. I'm glad I just ignored it and kept going then. Okay, so the headline number here, US PCE price index month over month spot 3 versus an expected spot 3. But personal income slightly higher than expected. Consumer spending slightly less than expected. So a little bit nuanced of a number here. Not a huge change. We are getting movement though. Looks like the dollar's getting weaker here though. Part of me wants to think this is good, like inline is good. But another part of me thinks that this might mean that this news doesn't really matter too much and that previous dynamics will take hold. Whether that means that the S&P 500 continues up from here or not, I'm unsure. Well, there's an aggressive bid right there. And we've already come down about 3 basis points. PK Trading Trader, good morning. Oh, that's you've been here before, haven't you? That's a name I recognize from a long ways back. Well, let's come in here to Twitter, see what's going on here. So I am concerned. Well, I shouldn't say concerned, not just once. I come here very often. Oh, okay. I think that end of month flows now become dominant, right? But I don't know what those flows will actually be. So I think that this is going to come back. So notice that the volume has kind of died out. Good morning, Meishan. Are you full time? Nope. It's a hobby. We're not gonna get filled here, are we? Okay. Or no, that fill was a little bit too good. Oh, that was way too good. Are you kidding me? I got filled and was able to get out without it ever being cleared. That's crazy good. Hey, listen, this may not go much lower than this. It may like just come roaring back and bust the high. But given that my break even is at 24, that was a pretty awesome pick, wasn't it? At least on the very, very short time frame, I caught a really, really good pick there. I guess I can do it again. I'm gonna do it again. Oh. That is not what I wanted to do there. I misclicked. It's okay. So I'm looking over here at the micros. So I'm just gonna do a little test here. Oh no, I don't like that. Okay, somebody did it for me. I wanted to see if somebody puts a limit order at 3525 if they hit it, and they did not. Very good. So, I'm getting a pretty good spot here, but they're going to have to cross that 21 area. Gonna have to cross that 21 area. I'm gonna be a little cautious with this though, because it is mostly a technical trade that I'm doing here. Right? I'm saying, since the numbers were not that interesting, that this dynamic is probably going to come back a little bit. So it's not impossible for it to bust out the top at 25. But if there's a liquidity hole at 23.5, I should be able to market make fairly safe in this area. So far, it's been working really good. Also, note that the liquidity on the offers is stacking here. I'm wondering if that liquidity there is advertising that they need to sell today. Okay. Does look heavy. Let's see if we've got any stories about the PCE yet. No, doesn't look like it. Hmm. VWAP's at 21 there. They're just crossing. I think they're probably going to come back through here. So the setup that we got here hasn't been very long. If they get through some of this liquidity at 20, half, and 20, we might find that like this whole area from 20 to 16 has low liquidity because it hasn't been very long, right? They haven't had very much time to build up. So, because otherwise I would maybe be thinking about taking some profit here. But I see that liquidity support below us is a little bit weak. These orders up here have adjusted a little bit. Should also note that the upside action that we got just after the news steepened the curve by quite a bit, but then now it is flattening back out. So that's a dynamic that I think will really play out in my favor. I would prefer to be like short the 5-year if we're flattening, but if we're flattening out, that kind of suggests that the trend for the day is down, not up. Forex Live says US dollar stumbles after PCE and gold nears 2,000. Yeah, they did cross 2,000 at least briefly over there in gold. Okay, well, by the way, we did get below 21, but the liquidity at between 19 and 20 is not just crumbling away. I think we need to get through there in order to really slide through here, but so far they're not. See, the orders aren't coming in at 19. Come on, they just need a little shove. They just need a little shove. Come on. Okay. 1533 at 19. Not necessarily what I want to see. Nick Timmeros just tweeting the PCE inflation numbers here. Okay, so what do we do here? Do I take the quick profit again? Or do I wait for a longer term kind of downtrend? A little bit more aggressive there at 19. Okay. I would say the deltas are in my favor, but not strongly so. Yeah. So I didn't like that. Darn. Okay, I'm out. Oh, and when I'm in a situation like this, I kind of wonder myself if I'm playing it too short term. Like from a really short term order flow perspective, I played that almost perfectly. Multiple times, in fact. I'm really impressed. I don't think that I would be able to do that over here in the micros. Not enough liquidity. And it's still kind of being a little crazy over here. But the spread is a little bit too much for me to try and pull that off. But here in the 10-year, I did pretty good. So again, could drop out the bottom here, could pop out the top. But at the moment, I'm not seeing the liquidity in the order flow supportive of that. So I'm going to play it safe for now. See that, yeah. See, I in a move like this, again, so hold on. I feel the need to explain myself because I think that there's something really important that you can learn from here. Maybe I'm just full of crap. I don't know. This is kind of a little bit of a fluid situation. But I'm going to try and explain anyways, all right? We had a really strong move up off of news on light liquidity, right? So then we come up into here and you start to get an area where you start to trade a lot of volume. You start to trade a lot of volume. The liquidity starts to show signs of flightiness. So like they'll only bid like 50 in the middle, for instance. And then even despite that, a lot starts trading there, right? So now I know, okay, they've formed a liquidity hole and they're going to develop a range here. So I was able to identify the liquidity hole and play the range. Now, the issue is that because we had such a strong move up, the liquidity down here in the like 17, 16 area, the latent liquidity, that is like not just what's resting, okay, but like what is overall going to be willing to buy is probably going to be not as much. It's going to be the same on the upside, but on the upside, it's already kind of established itself, right? So the upside, it's established itself. Now we want to see how firm is it on the bottom side? Because if it's not there, they could just completely fall down through the bottom, right? If it's not there, then you have a situation where they could very easily retrace it, especially if you're getting the selling, okay? But that's not what happened. They were relatively firm down here, and the bids were much more aggressive. So when we ticked up, the bid was immediately there. They were immediately hitting the offers. This is very not the case the other way. Okay, the offers weren't stacking very strongly. The market orders weren't hitting it very hard. And when I come back over to the chart and I look at like cumulative delta, for instance, right? Well, there's the initial move up of about, wow, 25,000 contracts. 25,000 contracts up. That, and how much have we come back? Maybe 5,000. So that's not really very supportive of this move coming all the way back. So what may happen now is we could come back to this liquidity hole. There's a pretty good chance that we come back to this. Well, I guess we're technically already there. Pretty good chance that we come back to this 23.5 area, right? Then maybe they take another attempt. But if they take another attempt, this area is not going to be quite as vulnerable. So you kind of missed the best opportunity to close that gap. And at least initially. We would have to see more flows coming down. Now, the key thing though, and the other reason why I think that it was best for me to be a little bit kind of cautious and playing the short game is because we have end of month, end of quarter flows, and I do not know what direction they are. Usually I have some information from analysts suggesting that it's going to go a certain way, and I'm not seeing that. I'm getting some hints from the market that it's a sell, but I'm not super sure about it. So I think it's best for me to just say, okay, I made how much did I make? 8. I made 10 ticks. That's good. 10 ticks is really good. It's usually really hard for me to make more than 10 ticks. So I think that I should kind of just let it do its thing for a little bit. Have you ever tried trading order flow in crypto futures? So I have never put live well, I take that back. I absolutely have. So here's the thing about cryptocurrencies. Order flow data is very readily available for you in cryptocurrencies, and the stylized behaviors of order flow that we're kind of relying on to do this kind of trading, it works in any market that has a limit order book. And some of the most important studies that kind of helped us prove, or let's not say helped us prove, but kind of suggest that that's the case, came from the cryptocurrency world, where these behaviors were verified that they happen in cryptos as well, right? So does order flow and the DOM and all of that sort of stuff help you in cryptos? Absolutely it does, okay? But, big but, there are a lot of problems with the cryptocurrency world in general, right? One of the big ones is that there are not very reliable order flows over there. The majority of what happens is speculation from whales. So you're trying to guess what one whale is going to do. It's not always going to make sense, and it's not always going to be predictable. The way that these large institutions behave off of news is fairly predictable. You can expect certain flows to come through based on certain things, but in the cryptocurrency world, you can't. Okay, so that makes cryptocurrencies really difficult to try and trade from an informed trader perspective. So you're kind of left to trying to trade almost purely on technicals, right? Which is hard, but I think there's enough inefficiency left in the cryptocurrency world. You might be able, you might stand a good chance at getting away with it. But then the other issue that you have is the risk of a strong adverse excursion against you is really high, right? Like if you're the wrong way on a move and cryptocurrency is going, it can just run against you so hard and fast. So that's the thing that really keeps me away from ever doing cryptos. So I've played them from swings, and I've made a few thousand from cryptocurrency literally out of thin air. So I should probably be more proud and brag more about the success that I've had in cryptocurrencies than I've had. It wasn't like I became a millionaire or anything, but I've been able to pull thousands of dollars out of that with no investment on my part, just from mining, right? But and then the other thing is that, okay, so then Do you swing it, Seth? Do you like go long Bitcoin at, you know, the start of a cycle or something like that? Well, no, because I'm actually getting some signs that this is not like your optimal risk reward in cryptocurrencies, but this is an area where there tends to be like some support, right? But as far as I can tell, like 90% of the volume and what happens in cryptocurrencies right now is happening on Binance. And I don't trust that exchange one bit. I don't think that even like half of that volume that happens over on Binance is real. And we know there's been instances where like Binance gets shut down, or like retail traders can't trade it and it's supposed to be down, but Binance keeps trading on some sort of like VWAP move. So you've got like their own algorithms continue to run. So that's super, super sketchy, right? The concern I have with cryptocurrencies is that regulators are going to come in, they're going to squeeze Binance, and if Binance goes kaput, then it will take a very, very, very long time for the cryptocurrency market to recover, and they're probably going to like a $3,000 price or something like that. So, and then after that, who knows if they can ever recover, because the regulations will be different, right? So there's a lot of concerns for cryptocurrency, but if you know all of that and you're still willing to take the risk and you really, really want to day trade cryptocurrencies, yeah, order flow can help you. Absolutely. It was probably a longer response than Turtle expected, but you can tell I have some unresolved. Oh, thanks. I agree. You can tell I have some unresolved feelings about Bitcoin, right? I'm just, I was really, the whole 2021 market just really upset me. It just made me so mad seeing all of these influencers taking money and not disclosing that they're making money on the project and stuff, and it pisses me off. Right. It makes me mad. It makes me mad because I really try hard. I tell you what, that, you know, I think that this really comes from working for Goldman. I've always had like what would you say? I don't want to say like I want to say a strong moral compass, but that kind of sounds self-conceited. But this is a trait of people that are ADHD and autistic sometimes, is that they will hold very, very strongly to their moral beliefs, right? So for instance, one of the things that's been going around for the autistic people on TikTok is they did this study where they asked people if they would do a certain bad thing, and then they asked them if they would do that certain bad thing if like nobody was around and nobody would know. And the neurotypical people were substantially more likely to do it, whereas the neurodivergent people were very, very much not likely to do it. So I'm kind of like that, right? And when I worked for the bank, they drilled that sort of stuff into you so hard. It's really quite striking to me. It's really quite perplexing to me that some of those big banks, particularly Goldman, has had so many big scandals, like especially that Malaysia fund one for Goldman. Oh, that was just an absolutely terrible scandal, and it's just so shocking that somebody that high up was able to get away with such a massive abuse for so long, right? Because their culture is so very, very much about your reputation matters. Integrity is like the most important thing. If there's some rule, we're always going to follow not just the letter of the law, but the spirit of the law, like all of those things. They drilled it into me. And so when I come over here and I start doing the live stream, for starters, you got to remember that I didn't come into this like, oh, I'm going to be an influencer and then make tons of money off of being an influencer. I didn't. That's not how it happened. I had always just kind of posted little things on YouTube for fun and for small groups of people to see, and the channel somehow kind of took off and became a lot bigger than I ever anticipated, right? And then I got good at actually making YouTube content, so then there was that too. It's still wild to me that we hit 10,000 subscribers this week, because we got there from 9,000 to 10,000 so quickly. Anyways, so I'm doing the stream. I'm thinking about that stuff all the time. I'm thinking what I say. I need to be very careful about what I say, because somebody on my stream could hear me say that and then go out and do something based on what I just said, right? I need to be very careful, because my audience is putting a great deal of trust in me. So I should never say something about markets or the way that markets behave or performance or anything like that I can't 100% back up with real factual empirical data that everybody can look at and verify for themselves, right? You notice if you go on some of my videos, like the really good videos, like the stylized behavior of markets video, proven market behaviors, or the inelastic markets video, you'll see some people in the comments that like kind of disagree, but you never see anybody coming in and saying like, well, this is completely false because blah blah blah, and here's this evidence and this. Like, it never happens, because I 100% check everything that I do, and I don't post it unless I'm like really confident about the information that I'm sharing. Right? So I'm doing all that and working hard and trying my best to be responsible with the trust that has been given me, right? And then you get all these shitheads that are just YOLO everything. They don't give a crap about their audience. They run every grift that they possibly can and just completely mislead people and suckered people into dumping tons of money into a market that was destined to fail. You know, it makes me so mad that there's so many influencers out there that have hundreds of thousands of subscribers, and they're completely irresponsible with it. Oh, it makes me so angry to think about. So yeah, I have like unresolved feelings about the 2021 market and the cryptocurrency market, and it's basically turned into I just don't want anything to do with it anymore. Like, if like sponsors and stuff will email me about crypto projects and stuff like that, and I'm just like, no, don't care. Don't even respond to them. Okay, well, we're back to where I got out at, right? It was 19.5. So I don't think that I want to be one of the guys that do the market orders coming in here, but we'll see if they break through this or not. I mean, the volume in the 10-year is still pretty flat. And what about the dollar? Well, the dollar could shoot higher here. I don't know. I don't know if I really got anything here. It looks like we may be at a decision point, but I'm not quite sure what it's going to do. Oh. There was somebody wanted me to endorse an education program that I had never heard of before, and I'm like, well, I try to avoid doing that. And I'm afraid they're going to come back and be like, well, you did it for Gary Norton, but I was like, not really. Like, I interviewed Gary, and I said you should totally take the free course, but I didn't endorse the full paid course. Okay, so let's see here. It looks like now I am getting New York Police Department tells every member to show up in uniform as a precaution in response to Trump indictment, despite no protests planned. Now it's gonna, if something happens, it's gonna be in Florida, right? Okay. The Fed's favorite inflation indicator, core PCE deflator, was expected to remain sticky at 4.7%, but it came in modestly lower at 4.6% year over year, the lowest since October of 2021. Headline PCE fell to 5%, the lowest since September 2021. The biggest contributor to the downside for year-over-year PCE was non-durable goods, but services costs are accelerating. Housing continues to dominate. However, while acyclical core inflation slipped, cyclical core inflation continued to march higher, which is a greater problem for the Fed. Cyclical core PCE inflation, which tracks inflationary pressures that are linked to the current economic cycle, is at the highest on record going back to 1985. It looks like we did finally break through that 18 area, and we did it fairly easily, right? So now we're back to the price from before the news. Americans' personal income rose spot 3% month over month, while spending rose spot 2%. Both spending and income slowed on a year-over-year basis. Inflation adjusted, we note that spending declined spot 1% month over month in February. So while there is some positive news on the inflation front, the ugly black lining to that cloud is that private wages bounced big from 6.7% to 7.7%, while government worker salaries dropped from 5.2 to 5. For some context, the trend growth in private wages is massively more aggressive than pre-COVID. Yeah, it is. Holy crap. Look at that. Look at that chart. The growth in private industry wages is pretty nuts. As a result of all of that, the Fed in February, the savings rate rose to 4.6, the highest since January of 2022. And finally, we note that while the market's inflation expectations have dropped in March, thanks to credit tightening fears from the banking crisis, it remains well above the Fed's target level. With last night's Fed data potentially signaling a slowing in deposit outflows, this morning's PCE suggests the Fed may have more to do than the hopeful doves in the equity market believe. Good analysis there by Zero Hedge. Okay, so they're bouncing back up now that they've kind of closed the gap up. So now we kind of enter into the area in the treasury market where we could get all sorts of messy action, right? So now that we've kind of established this range where the liquidity was low, they can probably very easily just trade back and forth across this at will. The question remains, what are the end of month flows? You know what though? So I took 19.5. I missed 1, 2, 3, 4, 5, 6 ticks maybe. That's not too bad. If I can get like within 4, 2 to 4, I'm okay. If they had like just kept going and busted through 13.5 before coming back up here, then I would be really upset. But okay, so now I'm thinking about that I might have some time to do some things today and this weekend. Well, I think this weekend we're finishing the desk. Ooh, and also I've got, oh, can I show you something really cool? I got, well, I don't know if I really actually want to go over and grab it, but I found these rack mount cases for my rack. So that's cool. I don't think I'm going to move my desktop into it quite yet, though. Definitely we'll need to get fans first. I need to think about if I really want to put the rack on the other side. I'm kind of hesitant to do it because I like the plant there and the books, and I want you guys to be able to see it in the videos, right? And if it was just like a big server rack, I wouldn't be as interesting. What do you think? I could maybe zoom it out and do more of a center shot so that you can see the plant and the server, but yeah, I don't know. I don't like it. Why do I want to move it over there? Oh, because I might put the table there. I don't know if we're actually going to move the desk this weekend, though. U.S. unveils stricter electric vehicle tax credit rules to take effect April 18th. Let's look at this real quick. The Treasury Department on Friday unveiled stricter electric vehicle tax rules that will reduce or cut tax credits on some zero-emission models, but grant buyers another 2 weeks before the new requirements take effect. The rules are aimed at weaning the United States off dependence on China for electric vehicle battery supply chains and part of President Joe Biden's effort to make 50% of U.S. new vehicle sales by 2030 EVs or plug-in hybrids. The EV battery sourcing guidance issued on Friday triggers a new requirement for critical minerals and battery components and takes effect for vehicle purchases starting April 18th. U.S. officials acknowledge some vehicles will see credits cut or eliminated. Tesla said Wednesday the Model 3 rear-wheel drive credit will be reduced as a result of the guidance. The government will publish by April 18th a revised list. The $430 billion Inflation Reduction Act signed by Biden in August eliminated manufacturers' EV sales caps but imposed new conditions on electric vehicle credits. They included a North American assembly requirement from August, price and buyer income eligibility caps from January 1st, and now the battery and critical mining sourcing rules effective April 18th. Alliance for Automotive Innovation CEO John Bozzella said in a statement his best guess is few EVs on the market will qualify for the full $7,500 credit after April 17th. He noted the requirement EVs be assembled in North America to qualify for any credit eliminated 70% of models. Some EVs will certainly qualify for a partial credit given the constraints of legislation Treasury's done as well as it could to produce rules that meet the statute and reflect the current market. The IRA requires 50% of the value of battery components to be produced or assembled in North America to qualify for a $3,750 credit and 40% of the value of critical minerals sourced from the United States for a or a free trade partner also for a $3,750 credit. Okay, so I wonder if this is affecting Tesla. I think it could. Okay. Well, so I'll bring over our stock chart here. Well, we got things. Let's just take a look at Intel. Intel is still higher again today, man. Oh, well, they haven't opened up today, but they were higher yesterday. That move on Tuesday was really good. Like, when this happened, I was like, maybe we should wait on Intel. And then this happened. So you're missing the boat on that one. Tesla. Okay. We move to a 5-minute chart. Well, Tesla is up slightly overnight. I think that this should hurt Tesla, but it doesn't look like it's actually selling it. Maybe you get an opportunity there, though. I mean, if there's not going to be as much of a credit, that's going to hurt Tesla's bottom line. Full stop, right? Let me come back here, see if there's any other interesting stories this morning. Not really. The news is going to be really messy this weekend because there's the whole Trump indictment thing. And I'm sure that there's going to be some sort of drama over, whether he gets arrested and how that all goes, right? So unless there's like new news about that out there, you might see people be kind of quiet. Well, look at that. The degree to which the 10-year treasury came back up after that pretty devastating downside retracement is almost exactly what I said, isn't it? It was like, okay, now you've got this really wide range that they can move freely across, right? Which on a Friday ends up with really messy trading. That doesn't mean that it's not worth trading anymore because we have end of month flows. We don't know which direction the end of month flows are going to be, but we might get some hints after the S&P 500 opens up. I keep seeing all these people on like Twitter and stuff talk about AIs and like, they're going to start trying to eliminate humanity soon and all of this sort of stuff. That is not how these AIs work, man. They're just trying to predict the next text token. That's it. With a reinforcement feedback, and yes, they can attach it to other things that can go out and do stuff, but these are not AIs that sit there and do this thinking like, well, humans are a scourge on the planet and I should eliminate them, yada yada. They don't work like that. You ever read the story on... That sounds familiar, actually. High frequency trading in a limit order book? I think I've seen this before. The role of dealer in securities. Oh, hi. My wife just came and dropped the baby monitor next to me. This one looks familiar. I think that this might be in my book. Hold on. Yes, this is in my book. Alan Venda. Yes, it is in there. So the trades, quotes, and prices book doesn't go into detail about that particular model, but they do reference that paper multiple times. I implemented it. It doesn't work. It gets massive adverse selection from correlated orders, but cool idea. Well, yeah, but that was like the whole thing, right? Is it's trying to manage the inventory in a certain way by changing what your spread is, right? But you would still want to have some other models on top of it to do stuff. So if you're into that sort of thing and you haven't read Trades, Quotes, and Prices, Financial Markets Under the Microscope, I would read that because they go over multiple market making type of models like that. Hedge fund positioning to long bonds done in the last few days, or now we're ready to go up. I don't know. Do you think that the March positioning is going to be long? That the end of quarter rebalancing is going to require them to buy treasuries? I'm not sure. It looks like the liquidity is thickening up a little bit here now that they've come back to 21 now. You've got it on both sides now. You've got orders that are close to 2,000. Do you think it's a buy? I'm still not sure. And the flows that I'm getting through this range are really iffy. Well, it looks like it's long in the 5 and the 30. Your R squared indicator might help. Yeah, that could. I would also say that using a correlated asset and trying to find some sort of arbitrage opportunity between the two of them would also be a really good bet. So to go into more detail about how that might play out, you put bids and offers at every price, but then you pull them whenever price comes into that price, unless your correlated asset suggests that that's a good fill price, right? And so you would have to do some math sort of thing, like construct an ideal yield curve and determine if this 20 half is outside of the yield curve or something like that, or construct some sort of correlation with the dollar, right? And there might be some even better opportunities to do that in like equities, because you could go and find out what all of the constituent stocks are, right? And then determine if that's a good fill there. So that's the first thing, right? And then on top of that, you can utilize the human knowing what's going on and everything, and knowing that you don't want to fight the order flow going this direction, right? Oh, yes, that was the equity open, of course. I was like, something just happened and we're moving around, and now I'm realizing, oh yes, because the equities just opened up. The price is looking supportive over here in the equities, but the volume is sell. Okay, they are buying. Buying in the treasuries, that is. Now that's interesting that the micros are touching at 5352. I was looking at that and I was like, well, you could hit that. It would have been a good take, but we'll see if they actually continue through here. I'm seeing some hints that they'll continue long. That seems to be the way that the flows are going, at least. Do you think AI is helpful or baloney in trading? What about for order book reading like you do? Well, okay, so machine learning algorithms are extremely valuable in trading. And in fact, I kind of am wondering if it is to the point where you really, if you want to have like a purely technical trading strategy of sorts, that you need to be incorporating the machine learning to some degree or another. I think that some of the models that we have would be greatly aided by like hidden Markov models sort of setups and stuff like that. And I'm kind of working very, very slowly on getting there. What I'm finding is that doing that sort of stuff, the machine learning part of it is not actually the hard part of it. The infrastructure is the hard part of it. Keeping all of the data, having the processing power, setting it all up to be able to run live and everything. So that's what I'm working on right now. So I got a rack, and I'm at some point I'm going to have 2 PCs, so they can have 1 PC just for data crunching, right? Okay, but this whole ChatGPT thing, where it's like, ChatGPT, write me a trading algorithm that will make money in the stock market, yada yada yada. It's total bull crap. Like, ChatGPT is not going to write you a profitable trading algorithm, right? The whole thing. So trading is an area where you have to be unique to some extent, right? Like edges that everybody is aware of, there's going to be high competition for. And how are you going to be the one that beats everybody to it? Right? Well, you got to be fast is the main thing, right? Are you the fastest? No, you're not, right? So you're going to have to find edges that nobody else knows about, okay? Well, how do you do that with ChatGPT, right? ChatGPT doesn't generate new content. It's taking other content that already exists out on the internet and using it to kind of understand how to form sentences and stuff, right? So any algorithm that it's going to give you is going to be, you know, what's already out there, which means somebody's already trading it, or like it's already arbitrage out of the markets, right? Yeah, ChatGPT, where is support? I think that ChatGPT could play a part. So you know, if you have an algorithm that is based on some sort of reinforcement learning algorithm, and it uses ChatGPT to be able to interface with you, right? Like a very powerful trading assistant could be created, right? But what you're seeing from people on YouTube is just nonsense. I never ended up watching that video that we were looking at yesterday that was like, oh, we made an algorithm in ChatGPT. I think what I'm gonna do is I promised you guys the problem with volume profile video, right? So I think I should probably do that one first, then I'll try and write it today. But then I'm going to do the one, and I'll go and find all of these YouTubers that are saying this, and you know, take the beginning of their videos and all of the clickbait nonsense, and then show you how these perform and how terrible they are, right? I honestly, what is the problem with volume profile? Okay, so let's go into that then. So volume profile, go come over here to the charts, is actually, it's kind of hard to bash on volume profile. One, because it is like just so ubiquitous in the futures trading space, right? But also there is some use to it, right? Volume profile and auction theory, which is I think kind of the main driving theory behind all of these ideas, right? There is something to auction theory. These were professionals in the market that were actually looking at the market and trying to come up with some sort of a system to explain how markets tend to move, right? And there is a strong, or a kind of statistical aberration in that we tend to get these distributions. Oh, we should do something with a little bit more volume. ZN, right? we get these distributions. If the market was purely a random walk, that's not what we would see. We would not see like Gaussian distributions, right? So they are picking up on something real, right? But in the end, their theories were not empirically based, and the market is a little bit more sophisticated than they anticipated. And so there's a couple of things about it that we kind of need to factor in order to actually make sense of this volume profile and use it effectively. Okay. So the biggest one, and the one that just I think is so funny, is that the majority of the volume ends up trading at the open and the close, especially in the S&P 500. So when you come in and you look at the S&P 500, so I have this indicator, I have these lines drawn on here to show you when the close is, right? So here's the close. Where's the point of control for that day? Oh, it's right at where the close was. Okay, here's the close. This one was not the point of control, but it was the point of control for this other distribution, right? Okay, here's the close. Yep, right at where the close was. Here's the close. Yep, it's right at where the close. So these guys are making a big deal over what was the previous day's point of control, and trying to base all of their strategies off of that. And it's just the close. So if you go back and you do all of your stats and you use the previous day's close instead of the previous day's point of control, you'll basically get the exact same stats, right? So that's the first problem. Too bad you can't know where it's going to close at the start of the session. Yeah. And the thing is that there are some interesting statistics that you can kind of glean out of that sort of stuff, but the aberrations that you're getting, or the stats that you're getting, and the supposed edges that you might see in those stats probably have more to do with volatility than they do anything in the order flow or having to do with the volume profile itself. Okay, so that's the first thing. Okay, the second thing, and the really big one though, is that they say, okay, when the market just stays in one spot for a long time and a lot of volume trades there, that signifies value, is what they call it. They say it's value, and that's because buyers and sellers agreed on a price there, right? Well, there's a couple of things that we know that suggests that that is an incorrect way to look at the markets. For one, we know that markets are inelastic, right? So most of these largest players that are buying and selling in the market are very price insensitive. And so they're not looking at like, there's this price that's a good price to buy at, and I want to buy at it or sell at it, right? But also, like, from a logical perspective, it doesn't really make a whole lot of sense. If I think that the current price is fair, why would I trade it? That makes zero. You don't buy or sell something because you think the price is fair, right? You buy or sell something because you think the price is too low or too high, right? So that situation, creating a lot of volume, and it because it's value, it makes no sense, right? But then the big thing is that we have this other study that kind of suggests why it happens actually, and that is in the Walrasian auctions to continuous double auction study. So in that study, we find out that when you come in and you trade, if you do a Walrasian auction, which is an auction where you can only put in limit orders and all of the orders get matched after 5 minutes and then it goes through again, you're going to get certain number of people are going to buy or are going to sell, and a certain number of people are going to buy, and there's going to be this overlap, and this overlap are the people that get filled, right? So the people that didn't get filled, their orders are going to move on to the next auction, and so you're going to get something that's kind of more like this now after that, right? There's going to be this whole area where there's, this is where the orders were filled, right? So it's going to take some time for new orders to fill this hole up, right? And when that happens, it makes it difficult to come out of that price. And market makers, there's not a lot of liquidity in this area, so it gets stuck. But it gets stuck and it's there for so long, you actually end up trading more volume in that spot than anywhere else, even though the resting liquidity is low there. It's like they put a little bit up, that liquidity gets taken out, they put a little bit out, it gets taken out, and it does that for a long time, and you end up trading more there than anywhere else. And so this, in my opinion, is a better explanation for why you get the profiles that you do, right? So for instance, on today's move, we had a strong move up, and then there was a little bit of a liquidity hole that formed around 21. They rotated around that a bit for a while. Somebody was able to bust through the lower side liquidity, so they fell down, but that very quickly sputtered out, and it looks like there's a stronger meta order buy, right? So that's the way that we kind of need to approach it, is that these points of control, they don't happen because it's some sort of fundamental value. It's actually kind of random, right? It actually happens because nobody wanted to trade there, actually, right? But the block orders and everything, they love those spots because you can get tons of fills there, right? And those liquidity holes are probably the most profitable spots for market makers. Yeah. You watch. What I do is, when I'm doing the market making stuff, is I watch for that liquidity hole to start to form, and then I start trying to get fills around it, right? So now you come back over to these charts and you kind of think about that. Now your whole approach to the market is a little bit different, right? So if I come over here and I look at this one, what am I going to say? Okay, so here was a strong meta order buying after the Federal Reserve. Okay, and then that was the end of the day. All right, then here there was a small meta order sell. They got stuck. Then there was a meta order buy. Now I don't have cumulative delta up here, but you kind of want to be able to look at your cumulative delta as well, right? Over here, strong meta order buy, gets stuck up here. That's the liquidity hole, right? Strong meta order sell. Right? And they would look at this and they would say, okay, here was a rise and they found new value and it was rejected. But that's not exactly what's happening. It came up to that price because that was just where the liquidity hole was, and it just happened that somebody decided to sell from there. And this move is somebody selling, and it's not like they're trying to bring it back to this value area down here or something like that. It's just he needs to sell X thousand contracts, and based on the liquidity, that's how far that tends to move the market, right? So when you kind of work from that framework, you can understand what's going on a lot better, right? But to summarize, the main problem is this idea that there's something special about that price, and that it represents something fundamental about the value of it, right? That's the biggest mistake that people make when they're thinking about volume profile. Am I understanding this right? The size of the meta order determines the magnitude of the move. Kind of, because you got to remember that it follows the square root law, right? So a large meta order, there's a limit to how far it can actually move the market, right? Which is why it kind of goes to where it does. Like the question, there was 30,000 contracts that bought it up, and it only got to 23. And we had moves yesterday that were as big as that. What's with that? Well, it's the square root law, right? It's dependent on, right, let me draw it out here. Y, which is a scalar unique for each instrument. Omega, the volatility, times the square root of the size of the order over the amount of volume for the period, right? That's one model. there's another model that you can use that would be based on how much liquidity is out there to be able to figure things out without using the YO part. Right? Volume profile sounds like hot garbage. Well, I wouldn't say it's hot garbage. Like, there is something kind of useful about it, because they did kind of identify that the way the market tends to move is you have a move, and then the square root law comes into effect and you get this liquidity hole. Now from here, is it more likely to go up or to go down? Who knows? But if it goes down, here's the thing, is if it goes up and then it goes like this, and then you go down, well, the liquidity will be recovered, and so it'll be just as hard to move down as it was to go up. But so you could do this, right? But if it goes up and they like immediately sell it an equal order the other direction, it's going to go further, right? These are the sorts of things that the volume profile they don't understand, they can't explain. Do you think there have been people or AIs that predict the size of a meta order at a given place, like a liquidity hole? Well, so I mean, I think that the reason the liquidity hole occurs is just because the liquidity in that location gets exhausted. And when you look at how that plays out, when you go from like a 5-minute auction and then you slowly make it a smaller and smaller auction until it's a continuous auction, you get that square root behavior. So you can kind of predict where the holes are going to be, right? Because basically you can draw a chart out. You can say, okay, based on my Y and based on what I know the Y is for this stock and what the historical volatility was and what the historical volume was, then I can graph it out and say, if they buy, how far is it going to go? And it will look like this, right? And you start to get this area where at first it's like linear, right? In this first area, it appears linear, but then you start to get to this thing. And so once you get to here and here, all of a sudden it's like you have a pretty good chance that a liquidity hole is going to form, right? So you can't predict, right? But then you can also come in and say, well, what do they need to buy or sell today, right? And you can use all sorts of predictors of order flow to make an estimate about how big of a meta order is out there to execute, right? Because what could happen is I could see it moving up a little bit, and it's like, well, it looks like there's a large meta order buying, and maybe they go up, they move up, and then they stay in a liquidity hole for 45 minutes, and then the liquidity hole has healed. Are they going to move it up another leg? Well, you could use your predictors of order flow to determine that the meta order that's being executed is probably 30,000 and we've only seen 10,000 of it. So they probably are going to buy for another leg, right? That's how I would approach it. You'll see that pattern all the time. You will. Because if somebody wants to sell, they're gonna want to do it right at the peak of this move, right? But you'll see this pattern all the time too. This one right here. People they draw them wrong. They don't realize. It's kind of funny that the chartists didn't pick up on this pattern, because this is the most common pattern that you'll see in the market, right? Let's come back and to our chart here, and let me see if I can show you some examples. I don't think that it's kind of hard to see on a 30-minute chart sometimes. Okay, like here on the S&P 500, right? It's kind of a curve, right? It's going to be like that. See right here, move up, and then what? Flattens out. This chart's not the best one. There's so I gotta tell you, they can be so clear in the treasury market sometimes. Although we might have to go back a few days because this week has been kind of choppy. We haven't gotten a lot of big meta orders. Okay, so like here's one to the downside, right? Right. It's a big move. They get stuck in the liquidity hole. Where's the liquidity hole? It's like right here. And look, they like just keep coming back to it and get stuck in it. And then after 45 minutes, they try it again. But then this move, like, look. Here's this move. Here's this leg of the meta order. Here's this leg of the meta order, right? This one is smaller. So that part of that has to do with of the square root law. Part of it might also have to do with Almgren Chris, which is that like the amount of orders that you're going to send this time versus the amount of orders you're going to send this time. This is going to be like half of that, right? So you can kind of see them playing out. And the thing that I think is so beautiful about all of this is that it explains why everybody seems to think they see patterns in the markets, but it's so hard to trade off of patterns, right? Because the reality is that there are patterns in the markets. There are certain behaviors that, based on the actual math of it, will play out over and over and over and over again, right? It's just that those patterns don't predict what's going to happen next, right? If I know that there's a meta order that's going to be executed of X thousand contracts, I can predict how that's going to play out almost to the letter. But if I have a pattern on the chart, it tells me nothing about if there's going to be another leg of the meta order or what's going to happen, right? You kind of have to know something more than just the chart. You know, like, oh, we had to move down, but like it doesn't really make sense, and there's probably going to be these guys that are going to try and trade against it. There's going to be a meta order the other direction. I can take this, and those are the best trades. I got to tell you, like the best trades that you will catch will be ones where maybe you like. I can give you one example. I can't remember what exactly the news was, but I can remember one time there was a big piece of news. It was like a jobs number or something like that, right? We move up on the jobs number, and then as soon as we got up to the peak, another headline came out that was very negative, right? So now you have a meta order moving up, and at the peak of that, you have a reason for a meta order the other direction, right? Oh my gosh, guys, take that one. Every time, take that one, because it will move further than the initial move. And those ones can just go so far. That's going to be where like your risk reward gets multiplied, right? Is there a seasonality intraday cycle where meta orders are more like? I think so. I think there is, because I think that meta orders are more likely to be executed because you would have the news at 8:30 Eastern time, right? You have that economic release time period, right? And then you have the S&P 500 open. So those are two places where you tend to see meta orders. And then there are other times that are like 45 minutes after that you're likely to see meta orders, right? Well, there might be some statistical behaviors there, like distribution of meta order sizes or detecting the start of one and fitting curve to estimate how long it'll last. So I don't know about detecting the start of one. Because what I find is that by the time you can really conclusively say that it's a meta order, it's like it's too late. You know what I mean? You kind of got to know that the meta order is coming and going at the first signs of it, because by the time it's confirmed, it's too late. Like by the time it's confirmed, that's usually where the liquidity hole forms. I like your style, deep diving into the whys and hows. I don't know if it's a me thing. I'm just kind of sharing the information that I know is missing out there, right? I want to dive into the whys and hows because everybody else just says, here's a pattern, it works, whatever, you know. Like, I have big problems with that. That the way that the market works, that tends not to work, right? Anyways, so Poopy Head Face, got to realize that the way that they kind of learned this square root law behavior was by actually getting flow from exchanges and banks, where you would be able to identify individual players, right? So then they could say, okay, the bank executed this meta order for this client, and here's the impact that it had on the market. And when you get a large enough data set, you see that square root law behavior. That's how they discovered it. So they weren't able to discover it just from the data that we have, right? It's like the following meta order sabotages the initial order because, yeah, that's exactly what, yeah. If you're making a speculative trade, you want to do it right when that square root law behavior starts to come in to take advantage of the weakened liquidity that they left behind. Oh, I forgot where you could get some more news here. So what do we got? We've got University of Michigan. Okay, so slightly lower than forecast at 62 versus 63 spot 3. Market not really reacting. But what are the inflation expectations? 1 year inflation expectation is lower than expected at 3.6 versus 3.8. But the 5 year is slightly higher than expected at 2.9 versus 2.8. So that one's also, I think, a little difficult to sort out, but I think that is a tepid buy. But I'm not seeing a whole lot of flow come out from it, so I'm not going to try taking a trade off of it. Looks like the S&P 500 is liking it. My whole thing is you got to realize the market has fat tails, right? So if I just come in and I take like 50 trades and then I say, oh, okay, I've proven something statistically, that's not how it works. The more fat-tailed a distribution is, the more data samples you need in order to prove the distribution, essentially, right? Because what do you got? You got these like really, really rare events, right? So it's going to take more samples to see those rare events, and the wider the tail, the more that you need. But the thing that's really interesting about it from the math is that it scales exponentially, right? So if you look at, there's a measure called kurtosis, which is how fat-tailed it is, right? How common are these really big events, right? The number of samples that you need scales exponentially with the amount of kurtosis. So like if the kurtosis is 1, then it needs like 1,000. And if the kurtosis is 2, it needs 10,000. Something like that, right? So the amount of data that you actually need to really prove something in the market is usually a lot more than retail trader thinks. So what a retail trader will do is they'll come in and they'll say, do this thing for 2 weeks, and then, you know, keep the stats about it, and then try taking advantage of that thing. Well, that tends not to work because you don't get enough samples and you're not trading in a wide enough variety of markets, right? And so you're going to find that signal or whatever it is you have probably changes in different market conditions, right? So what do? Well, you're going to have to rely on statistical evidence that is really statistically significant, keeping in mind the fat-tail nature of markets. And so that's where we turn to scientific research. And there's a lot of scholarly research out there where they provide the data and everything to show certain market behaviors. Now, it's interesting because the behaviors that they show are really, when you think about it, it's quite a limited claim, right? The size of large meta orders tends to follow a square root law. Like, that's actually a very, very specific, very limited thing, right? But when you really think about it, they do have consequences, and you can adjust your trading based on them, right? Now, that's not a strategy, right? And that's kind of the issue here, is I'm giving you proven information about the behavior of markets. Okay. From there, I'm building my own strategy based on that. And because my strategy is discretionary, I cannot backtest it far back enough, you know, to prove a statistical edge with it, right? So there's always kind of this leap of faith point at which, you know, you're a retail trader, or because of the nature of the strategy, you can't empirically prove the strategy, but you can prove that the ideas that the strategy is based off are based on empirical ideas, right? Most of the strategies that retail traders are sharing amongst themselves are based on ideas about the markets that are just wrong. And that's why I'm always sharing this empirical information, is not just because it gives you an advantage, but because it just destroys so many of the ideas that people have about how the market is, right? Theory and preparation is easy. All theory is nice, but if you can't perform, then it's all meaningless. I think that you are 10 times more likely to perform well with a sound understanding of markets and an empirical understanding of markets than anything else. And why is that? Because the market, again, it has fat tails. So what the market does is it lures people into trades that, from our natural human instincts and so forth, seem to make sense, and they're actually wrong. They don't actually. That's not actually how the market works, right? But the market preys on your natural instinct, right? It's like if you're going to go and play basketball, right? You go in and you're defending against somebody, and you see the guys start to move to the right. What are you going to do? You're going to move to the right. Okay. That's what everybody's going to do. That's like your first natural instinct, is to stick with that guy. So what do professionals do? They lunge and don't move, right? They lunge and don't move to get you to fake you out, to get you to move the other way, and then they go the opposite direction, right? They're using your natural instinct against you, right? And thus it is with the market, right? So what you got to do is you got to come in with an actual correct understanding of the market, come in and utilize all that information, develop a strategy, and then you've got to practice to get it right, because your brain is a neural network, right? So if you have that neural network that is interpreting the information that you have correctly, then over time, you're going to be able to build your brain up to be able to interpret those situations quickly and correctly, right? What's happening to most retail traders is they're coming in and they're doing that trading every day, but they have an incorrect understanding of markets. And so the data that they're actually using to train their neural networks is nonsense, right? So they're trained to see these price patterns that aren't predictive in the least bit. They think they are, but they're not, right? And so it's constantly like you think you see that pattern and then it's not actually that, and you have to bust, right? It's because you're providing your brain faulty data, right? Like if we're going to like the machine learning bit, right? So typically what you want to do is like, here's the exchange, data comes in, right? So now to my computer, to me, and then I save it to disk, right? Okay. That information that I get, that I save to disk, is literally just every order that happens, what price it happens at, every change in level 2, which price it happens at. So every one of those events, and it saves to disk, right? So, well, guess what? That's not actually very useful to you. So what you need to do is you need to do a transformer. Okay, so why you do this transformer, and that will translate it into things like cumulative delta, liquidity, etc. Right? And then I take those data series and I create what we call features. Okay, then you pass the features into machine learning, right? Are you actively recording those events? Every individual event. It's actually not as much data as you would think. Couple of megabytes a day. And when you have like 20 terabytes. Okay. So what people are doing is the features that they're using are like pivot points, right? So they're passing pivots in, and then they're passing that to their machine learning, their brain, right? And because this is noise, right? This is what they're doing. You're actively training your brain on something that's nonsense. And then you struggle. And retail traders think, well, it's my psychology, and they spend all of this time on psychology, when the real problem is that there was never any, like, your brain is trying to trade something. It thinks that there's an edge to it. There's not actually an edge to it. That's going to make anybody crazy. That's going to lead anybody to become crazy. Right? It would be nice to get my hands on the big order data they use. I think you might actually be able to. I don't know. I was on Rhythmic. Do all of the events? Yeah, it's only a few megs a day. Believe it or not. I'm only recording like 2 or 3 hours, so that kind of helps. But would you say retail trading and Forex is one of the only markets where it's one of the... No, I wouldn't say that at all. So in the Forex market, you can't see the orders, you can't see the order flow, and since order flow is where some of the strongest and most reliable empirically based market behaviors that we have come from, not having that data is a huge disadvantage. I'm just doing one instrument. I think it just saves a ZN. Here, I'll show you. Cash. So I have an indicator called data pipe. Okay, so it's like 200 megabytes a day. Right. We could actually come in here and sort it by name. Oh, today is the 31st. Oh, really? It hasn't been very long. Oh, you know what? I might have deleted a cache at some point. Might be missing some data now. Market data. Paste. No. I think I saved it. So you have it going almost all the way back to... oh, I think I do have some gaps. Oh, that's unfortunate. I might have put them somewhere else. So how big is this folder now? 16 gigabytes. Cool. So I can do that. If that's so, I can do 10 in a terabyte times 20 terabytes, right? So I can like hold 200 times that, right? We're kind of in a really weird space in the computer world where we both have incredible data consumption needs, and yet the average person doesn't realize our ability to save data. Like I don't think the average retail trader realizes that for $100 you can go and buy a 20 terabyte drive and basically save like every event, right? It's a custom indicator that I wrote in NinjaTrader, yeah. On the split side, the computing power that it takes to train something like ChatGPT is insane. Like, there's a reason that Nvidia's stock is up so much, right? Do the same thing for crypto exchanges. Have you inspected? Yeah. Well, I mean, that's what I'm doing. I just get every event. I've gone and I've done it for cryptocurrency exchanges too. Like I've used the WebSocket to create a consolidated tape for Coinbase. It's out on GitHub somewhere. Haven't used that in a long time. People really liked that one at the time. There's a lot of things that I've done, and I'm just so ADHD that I forget about them. That probably somebody with better at marketing and more focused than me could come in and market them and make tons of money. But so as I had another thing about the execution, right? The other thing that you got to remember is that you can make money from taking on risk alone, right? If I come in and I say, I'm going to buy at 22 and I'm going to sell at 22 half. Okay. And in order for me to stop out, it has to go all the way down to 16. Well, what are the chances that 22 half never ticks again, right? Like that's an unusual situation. That's like it had to have pivoted right there in order for that to happen to you, right? So if you have like this really wide stop, you're really likely to get that 22 half, and like 80-90% of the time you're going to get it. Yeah. It's just that one time that you fail, you're going to lose 16 times what you generally make, right? So a lot of retail traders do this, and there's lots of different ways to do this too. I'll give you an example of another way to do this is I take 2 contracts and I will stop out if it goes down 4 ticks, but I will take a profit on my first one if it goes for 3 or 4 ticks. So, and then I'll let my last one run. So most of the time I'm going to get that, that first lot filled because it's so close, right? But if it immediately goes against me, I'm going to lose twice as much. So there's still actually this risk reward. It's pretty similar. If you look at, okay, my max loss is actually 8 ticks because it's on 2 contracts, and my average winner is actually like 6 ticks, and then every once in a while I'll get one that like goes 10, right? So what you're doing is the same thing. It's just in that instance you're kind of splitting it up into different times, right? You're only taking on the excessive risk for like a very, very, very short time period, right? But it's the same thing. It increases your left tail. It increases your left tail, right? So there's a bunch of different ways of doing this, and people don't realize it, right? So the point was, how do you actually know if you're performing? Right? Well, I tell you what, if you're coming in and your risk reward are like equal, right? And you have a certain percentage hit target that you're supposed to get. Now you get good feedback, right? Now you get good feedback, and you can see if you're performing, and you can adjust yourself constantly on how you're performing, because the data that you're getting is actually useful data, right? If you are doing a skewed risk reward ratio, then the data, most of the data that you're getting is not actually accurate, right? It's like, I think that it's going to go up, and it moves up one tick. Was it actually a good trade? Or like, I think it's going to go up. It goes 4 ticks against you, and then it comes back up, and you get the 1 tick. Was that actually a good trade? No, because your MAE was terrible, right? So you need to actually have the data to be able to give yourself feedback to actually improve. And the issue with these skewed risk reward trades and stuff that most people you see doing, it doesn't actually give you valuable feedback about how your trading is, how good your trading is, right? And if you come in similarly, if you have an equal risk reward, but the entire basis of your strategy is based on something that's incorrect, doesn't matter how good you get at it. It's your results are still going to be mostly random. What is the micro? I don't think that there is one. The liquidity hole is my term. Actually, I don't think I came up with it, but that's the term that I use. And the only study that I've seen about this one is the one by Jean-Philippe and I think it was Farmer, about Walrasian auctions and a continuous time auction. That's the one where they kind of explained why this phenomenon occurs and how it relates to creating the square root law. If that big risk you mentioned is about 1 to 5% of your account, it can be profitable. Yeah. You know, like one of the big issues with the way that I trade is that the market is fat-tailed. And so you're going to come into these periods where the market gets really, really volatile. And if you catch it correctly, you just smack it out of the park and makes your whole year. And if you get it wrong, you just get totally screwed, right? That's why when the market starts to get too volatile, I tend to pull back from trading, because my solution to that is to just avoid the tail altogether. Nassim wrote about liquidity holes in 1997. Well, but is he talking about the same thing that I am, though? I've never heard him say anything about liquidity holes. I guess over the years we have understood when to trade. Yeah, I think that one of the biggest things that you're trying to determine, that you're trying to learn as you're coming in and trading every day, is when to trade and when not to. That's probably the strongest edge. No, Akshay. That's not what I asked. I didn't say he used that exact term. Was his definition of the term the same as mine? Was he talking about the same phenomenon? Let's see. You have a link for me. Liquidity holes. Whoa. Abstract. Trades with short horizons and privately known loss limits interact in a market for a risky asset. Risk-averse long horizon traders generate downward sloping residual demand curves that face the short horizon traders. When the price flows close to the loss limits of the short horizon traders, selling of the risky asset by any trader increases the incentives for others to sell. Sales become mutually reinforcing among the short-term traders, and payoffs analogous to a bank run are generated. A liquidity black hole is the analog of the run outcome in a bank run model. Short horizon traders sell because others sell. Using global game techniques, we solve. No, this is not the same thing. We solve for the unique trigger point at which the liquidity black hole comes into existence. Empirical implications include the sharp V-shaped pattern in prices around the time of the liquidity black hole. I guess what they're saying is kind of similar, but it's also a little bit different, because they're saying, oh, there comes a point where like everybody sells because like everybody's stop gets hit or something, and then that kind of creates this black hole. When I'm talking about a liquidity hole, it's really not the same thing, because a liquidity hole can be created just by a large transaction happening in a certain spot, right? What kind of creates the liquidity hole is the market makers taking on a lot of inventory in a spot, or the price zooming through a spot so quickly. Yeah, a spot point where people stop putting in orders for some reason. I would say it's related, but it's not quite the same thing as, I mean, really you want to read the Walrasian auction, right? And in the Walrasian paper, they don't call it a liquidity hole. But I guess what I'm trying to say is that if you're trying to learn more about this particular phenomenon, I don't think that liquidity hole is the search term that I would be looking for. The search term that I would use is Walrasian auction, right? So let me show you. Walrasian auction scholar. There you go. From Walrus's auctioneer to continuous time double auction. That's the study that you want to read. Sorry, it's J. Danier and Bouchot. Pretty sure you can get it on. I wonder, is this one? Oh, it's named, it's two things. Okay, here it is. Here, just, because I've talked about this a couple of things. I don't know if you download. This is the because it was Trading Bunny that was asking, right? That's just download that paper from SSSRN. That's the one that you want. We'll read the abstract. In standard Walrasian auctions, the price of a good is defined as the point where the supply and demand curves intersect. Since both curves are generally regular, the response to small perturbations is linearly small. However, a crucial ingredient is absent of the theory, namely transactions themselves. What happens after they occur? To answer the question, we develop a dynamic theory for supply and demand based on agents with heterogeneous beliefs. When the inter-auction time is infinitely long, the Walrasian mechanism is recovered. When transactions are allowed to happen in continuous time, a peculiar property emerges. Close to the price, supply and demand vanish quadratically, which we empirically confirm on the Bitcoin. This explains why price impact in financial markets is universally observed to behave as the square root of the excess volume. The consequences are important as they imply that the very fact of clearing the market makes prices hypersensitive to small fluctuations. Let me read that last part again. The consequences are important as they imply that the very fact of clearing market prices makes prices hypersensitive to small fluctuations. And thus you get this little spot where it just kind of like goes back and forth. Or you get this area where they can just go back and forth across, you know, they can really move across this whole area, but they can't move outside of it. Why? And it's because of they've cleared the prices, right? Just read that paper. Just read that paper. That's where I'm getting it from. And if I say something about it that contradicts something in the paper, then we should discuss it. Because I'm, you know, I wouldn't consider myself the expert on it. I would consider Jean-Philippe Bouchot the expert on it. And I am just the guy that has disseminated this information to retail traders, right? Right? I mean, notice I don't want to be the guru. I mean, I probably should. The YouTube channel would probably be more popular. That's what people want, is they want the guru. So why do I avoid that? Because I don't want you to take the perspective of I should just follow this guru and do what he does, right? I want you to take the perspective of Jean-Philippe, to go in and do scientific research on the market and see what's actually there and get good at doing that. That's what I think you should be, you know, putting your time and energy into, right? And studying the actual like proven market behaviors rather than looking for some expert to have them tell you. Because that will work in like every other field of study, but in trading, you're going to have to come up with your own stuff, right? Well, I do preach like a guru when it comes to basing your trading off of empirical evidence. Yes. Well, a lot of the time the study doesn't help you be a retail trader. That's true. There's a lot of information out there that I'm not. Maybe there is a way to apply it to retail trading and I just don't see it, but there is a lot of information out there that you can apply to your trading for sure. But like, here's the thing, is that if you actually have the empirical data in front of you, like you can make those determinations, right? When you're just following some other guru, you don't know anything. You don't know if it's real. You don't know why it happens. You don't know if what they're telling you about it is accurate, right? Versus what I'm telling you, you can go out and verify it yourself very easily. Because you can go and read the Walrasian paper. You can see what their data was and what their math was and how they came to the conclusions that they did, right? That's the difference. Yeah. Am I like a guru about it? I don't know if guru is the correct term. It's like, yeah. So explain to me how you're going to perform without an actual edge, right? It's not like you can just come into the market and say, if I believe hard enough, I will be successful at the trading. If I try it hard enough, if I watch it long enough, I'm going to be good at the trading. Because I can tell you, I know people that come in here and they've looked at the market for literally 30 years and never made a cent from it. Another question, most of the research CFM. Well, I wouldn't. Okay, so CFM is a different thing, right? CFM is the firm that Bouchot made. And the stuff that they're going to put out is going to be mostly like promoting their strategies and stuff like that, right? The perform is easy, important, but obviously easy. The edge is hard, right? Yeah, so it's like getting into the performance is like a second part. You have to have an edge first, right? You have an edge first. Now that you have an edge and it's an edge that you like know is actually a thing, then you can start thinking about how am I actually performing, right? Because you know how you should actually perform, and you can look at what happened afterwards and you can see how you did it wrong and stuff like that, right? If you don't actually have correct information, you got nothing. You can't do it. Oh my gosh, the dog came in here with my wife. Hold on a second. No, that's not true. I would disagree with that. Okay, so what is edge? Depends on what our definition of edge is, right? My definition of edge is knowing something that other people don't, or having an ability that other people don't, that gives you an advantage in a competitive marketplace or a competitive interaction, let's say. Because you could say that you have an edge in basketball, right? One edge in basketball could be that you have a superior knowledge of how the pick and roll plays out. Get superior knowledge of pick and roll plays, right? But another edge that you could have is that you are just more accurate at shooting the ball, right? Okay. Unfortunately, in trading, the kinds of edges that you can develop that are just based on like your actual skill, like how accurate you are at shooting the ball, there's not very many of those. It's largely an intellectual thing, right? That's an edge. Okay. So it would have to be information, and it would have to give you a competitive advantage, right? Now, there's another part of this, which is a strategy, right? So just because the strategy was based on empirical data doesn't necessarily mean that the strategy is effective, right? So that's kind of where I said again, there's always a certain point in trading at which you take a leap of faith. Unfortunately, because what we're doing is discretionary and everything else like that, we can't really prove if the strategy or if Seth's strategy, we can't prove if Seth's strategy is effective or not, right? I can show you how I've performed with it over the past year, but that's not really, again, just like I say for everybody else, it's not really particularly helpful for you because you don't know if, did he take other trades outside of that? Was he really actually trading on the strategy that he's telling me, or like he thinks that's how he's executing it, but that's not actually how he's executing it, right? So, or it could just be he's lucky. He's only been successful with it for the past year, and when you look at 5 years, that's not going to be the case, right? So, how my strategy on it performs, I can't prove that part, right? That's not empirical. What is a strategy? A strategy is a method of interpreting information to make and place trades, and then managing those trades after you've had them. So all strategies involve taking in information about the market, which could include the price information that you get, the limit orders, the market orders, information that you're getting from your news squawk, information that you're getting from certain analysts and other fundamental things, right? You're taking all of that information together, right? And then there's the analysis portion of it, right? So there's the data, then there's the analysis portion of it, which is which forms of analysis do you perform on that data? And then there is the execution portion of it, which is based on your analysis, how do you use that analysis to actually place trades, right? And then there is the trade management portion of it, which is what analysis do you do once you're actually in the trade, right? And then, to determine, for instance, where you get out, right? And those are all of the components that comprise a strategy, right? So at each step of that, we're going to be using, explain it. Why, what are you trying to get at for? I don't know if this is something that you can do with 77 IQ. Oh, man. Okay, but I'm kind of waiting to see what he says next. I don't know. Anyways, so the strategy is actual application of it, right? So what I want to do is for every part of my strategy, every piece of analysis that I do, every rule that I incorporate into how I trade, there's going to be a reason behind it, right? And I want that reason to be based on empirical evidence if I can, right? Okay. So I think that the components of a strategy are the data that you're taking, that you're consuming, the analysis you're doing on that data, and then your entries based on that analysis, the management of the trade while you're in the trade, and the exit. Or you could just, this whole part right here is execution, right? Plan of action designed to achieve a long-term or overall aim, right? So when you're talking about like where does edge come from, right? Edge will come from one of those three things. It'll be either in the data that you have, the way the analysis you're doing on it, or your execution. Okay. All edge can be put into one of these three categories, right? And just realize that this execution part right here, it's pretty difficult, if not impossible, for a retail trader to form an edge based on execution, right? There may be some places, but most of, you're not going to be able to trade it faster than the robot, for instance, right? You have to manage a trade, then there was probably, well, no, that's not true at all, right? So if I get in a trade and it's a trade where I plan on being in it for 30 minutes and then something happens before the end of that 30 minutes that tells me that it's going to stop and turn around, I just get out there. That's part of the management of the trade, right? Yeah, give me an example. Yeah, an example would be I'm long on a trade for a meta order that I think is going to be 20,000 contracts to the upside, right? So two things that would happen in the management, right? Number one is I get in and I'm not seeing that meta order. I'm not seeing that cumulative delta go up, right? So I scratch the trade because I'm not actually seeing the meta order, right? Or another thing that could happen is I could get into the trade and it does start going my way, but then an unexpected headline comes out that I know will move the market the other direction and will cause orders to come in the other direction. So I will exit that trade immediately right then and there, right? So those are both two examples of managing the trade. So it's all part of a set of, well, I think that my answer is much more sophisticated than that, right? Because if you come in and you say, well, it's just a set of rules. Okay. So how do I go from that to creating my own set of rules, right? Well, when you come in and you use my framework, now you can come in and you can say, okay, what data do I have? Okay, most retail traders, they only have price, but I have the limit orders and I can do order flow analysis, right? So that's data and analysis. The analysis is I have empirical data about the stylized behaviors of order flow, right? So that's a form of analysis that I can do that gives me an edge. There's a piece of data that gives me an edge. Those are all small little parts, right? And those edges are all based on what? Empirical data. There's reasons for me to believe that those pieces of information are going to bring an edge to me, right? I'm going to take in the news. And I'm going to do an analysis on the news based on my understanding of macroeconomics, which is like a really complicated thing, but you know, we could dive into, right? So that form of, and there's a reason why I think that analysis is going to be effective, right? Have empirical data that suggests that these are the way that the economy tends to behave and so forth, how the market tends to react to these things and so forth, right? Sim, can you talk a bit about options versus futures and the benefit to trade options? Because I feel like I make no progress trading futures. Okay, so there's a couple of different ways to do things in options and so forth, right? But I think one of the big differences in options is that your ability to actually price the asset correctly is a much more significant part of options. So in options, you've got to be having some spreadsheet where you say, okay, this is what the option is currently worth, but based on my analysis, this is what I think it should be worth, and therefore it's a good price or whatever the deal is. Sophisticated was reserved for the sales team. It's not. It's what we do is not easy. What can I say? See, here's what I think happens: is most people, they did not do this from the position of, okay, here's research. Like, it's a bottom-up approach, right? Which I guess is kind of more common to my my neurotype, I guess. But I'm going to come in, I'm going to look at all the research that I can find. I'm going to find every piece of information that I can prove is verify is true. And then I'm going to craft a strategy that utilizes as much of that as I can. Right? And then I'm going to verify that strategy itself as much as I can. As a retail trader, our ability to verify that strategy, especially a discretionary strategy, can be very limited. Okay, but we can still look at our stats and check ourselves and see our progress and stuff like that, right? Okay. That's not the way that most people do it. The way that most people do it is they look for somebody else to give them the strategy, and then they try and practice the strategy and get good at it, right? So that strategy could be based on empirical evidence, and they just don't know about it, right? What I use Rhythmic for my data provider, but I am using kind of a hack. I'm using a demo version of NinjaTrader, and I'm using a pre-NinjaTrader 8.1 version so that I can use Rhythmic data. Because if you go after 8.1 or you're using a new license, you wouldn't be able to do that. So the data that I use probably won't be appropriate for you if you're going NinjaTrader, right? If you're going NinjaTrader, you're probably just using NinjaTrader and you use their continuum data. Or there's another one that you can pay like $100 a month for if you want. Options: a choice between getting owned by time or direction, futures, an agreement to lose your future money today. Yeah. Well, if I think I know something's going to happen and the market is underpricing its probability, then I will try taking the options. That's the way that I like to try and play it, right? You notice that I will always lean towards using an informed basis for my trade, right? But I mean, it's worth saying, like, I think that you can build a profitable strategy. I cannot come in and prove that anybody's strategy like works. I can prove that people's strategy doesn't work. Okay. But the chances are, if you have a strategy that works, that there's probably a great deal of discretion involved in it, right? As a retail trader, at least. And, but what I've found over the years is that if you do have an edge and it is a profitable strategy, that the amount of money you make from it as a retail trader is not that much, unless you get really lucky, right? So I'm not out to try and convince anybody to day trade. Most of the guys that I knew on Wall Street, at least, would tell you not to day trade, because they would say, like, their view of it was, here's all of the data and information that I have to be able to make my decisions, and you don't have any of that. So how are you going to be profitable without any of that stuff, right? That's their approach. I think it's possible, but it is hard. It is hard. And the reward that you get from the amount of effort that you put into it, for most people, it's not worth it. Unless you like really truly enjoy it, unless you're like obsessed with it, it's probably not worth it, right? There are no profitable strategies that work only in theory. No, that's not what I said though, right? What I said is the only way that we can prove that a strategy is profitable is if we can automate and test it over any data series that we want. That's the only way that you can prove that a strategy is profitable. No, having made profits from a strategy does not prove that the strategy is profitable. It does not. If you ran a computer, if it was a robot that did it, if it was a robot that did it and it had 5 years, then I guess that would prove it. It's like saying, is LeBron James or Michael Jordan a better basketball player? Well, I could look at how Michael Jordan performed in the past, right? And say, based on his accomplishments, he was a better basketball player than LeBron James. But if they did a one-on-one in basketball right now, LeBron James would probably win, right? There's like this human element in it that's constantly changing, right? And in 10 years from now, will LeBron James be a better basketball player than Michael Jordan? I don't know. When they're both past their prime, because maybe LeBron James gets fat, right? How can I possibly know? You can't prove that. It's not empirical. I can make guesses. I can try and predict and stuff like that, but to like really empirically prove something, you can't, right? Yeah, proving edge like real statistical proof is really flippin' hard to do. It is. That's exactly the point, right? See, the retail trader thinks that, well, what I need to do is I just need to come in and make enough money, and then I've proven myself, right? And what the retail trader doesn't realize is that the amount of trades to actually prove yourself like that is really, really high. And then even then, the market could change, you could change, etc., right? Because you're this wild card in there. You've traded a lot of strategies, but no success. Well, then my invitation to you is to watch the videos about empirically proven behaviors of markets and try creating a strategy based on that information instead. Don't try copying somebody else's trade. Don't try and copy I can teach you a lot of like effective forms of analysis and stuff like that, but I wouldn't want you to try and trade exactly the same way that I do, right? I want you to I'm trying to teach you how to become effective at creating strategies, right? Part of that is understanding what the market actually does, because if you create a strategy that's based on the market moves up when Seth raises his right hand, that's never going to work, because the piece of information that you're basing the strategy on is bullshit, right? Don't you think it's reasonable to prefer advice from someone who is able to perform? No, I don't. So here's why. Because the people that are out there that are claiming to perform, if you're looking for somebody that is claiming to perform, that makes it more likely for you to run across somebody that is full of shit, right? So the people that are truly able to perform, what are they doing? They're working for a firm. Like seriously, if you really could like perform like that, why would you not have a fund or be picked up by Wall Street or somebody like that? And then at that point, you're not really allowed to get on social media and yap about it, right? So the only people that you're going to find on social media spouting off like they're making tons of money are people that are lying. So yes, going for anybody that claims that they're performing, it's a really, I understand why people do it, because humans are social learners. They want to see who was successful at the thing, and then I'm going to go and copy how they did it, right? So you're saying you're here because you can't perform? I am not making millions of dollars. That's correct. Also, I don't want to go and live in New York, because I bet you that if I lived in New York, I probably could get a trading job. At this point, I think I probably could get a trading job, but I don't want to live in New York. But I'm not making millions of dollars. I'm making dozens of dollars. Right? And I'm really not interested in taking on excessive risks. I could come in and start risking tens of thousands of dollars at once and turn it into 100,000 or $1 million, and then I could run around and claiming that I've performed and I have the track record and all of this bullshit, right? But is it actually like useful? Like, it doesn't. The second Octavius account, what are you talking about? You're 37 without a track record. You might be right. Nah, I think that if it was Octavius, that Octavius would just use Octavius. Anyways. But I'm what I'm trying to say is that looking for somebody that quote unquote performs is not an effective way of doing it. It just leads you to it just leads you to what's that starts with an H. How about becoming a money manager? I'm kind of working in that direction. Octavius is like, what are you talking about? How's it trading? I made like $13. So I don't know. I guess it's been okay. It was, I mean, for as tight of a week as it was, it's actually pretty happy about it. So. Do you think I should, Akshay? My plan is to do a series 3 and then reassess. You think I should? Okay, then I guess I'll do it. That'll be a long time from now, though. I don't know about the meta orders being fractal. That sounds interesting. I don't know if I have the excess brain power at the moment to think about how you would go about studying something like that. Series 7 is better in most every scenario. Okay. I mostly did the Series 65 because I just wanted to test out taking a test, I guess. Because ultimately I wanted to do the Series 3, right? The 65 was harder than I thought. It took me a lot longer than I thought. A Series 7 will be hard, but I think we can do it. I think that what we did with the 65 says that I can get the 7. If you don't pass the 7 the first time, you'll be forever mocked. Well, I tell you what, when I did that 65 test, I did not sign up for it until I was 100% certain that I was going to pass it. Yeah. I mean, it illegally allows you to handle other people's, which is self-open source. Well, okay, we'll work on it. But no, I didn't get to make the point that I wanted to make, right? The point that I wanted to make was, even if I was making millions of dollars, I would not be marketing myself by saying you should follow and do what I do because I've made millions of dollars, right? I would be saying you need to look at empirical data and build a strategy off of empirical data, because I would know that what I did wouldn't necessarily work for you. There's things that I know, there's things that I can do that other people can't do, right? So you can certainly learn from me, but I don't want you to learn from me because I am some supposed outperformer or something. I want you to learn from me because what I'm saying is backed up by empirical evidence, right? So the whole point is that you will be more effective, you will learn faster, and you stand a better chance at being successful if you base your strategy on empirical data rather than somebody else's supposed performance with a strategy. That somebody else's supposed performance with a strategy is a heuristic that people use, but it is not effective in a competitive market. Okay, so that was the point. So, should I change the title of the stream? I don't know. We had some good talks today. I don't know if I convinced Lucas yet, but it's time for me to go. So I will see you on Monday. I got a lot of stuff. This is going to be a crazy weekend. So I'll see you guys on Monday. In the meantime, stay